fundsupermart.com.
Hi Bill, since the last time we spoke, the fund has increased its exposure to the fertilizers and agricultural chemicals sector based on its latest fact sheet. Can you explain this allocation?
Sure, that's entirely correct. We have increased our exposure to fertilizer companies from about a year ago when we had about 32%. It's now up at almost 41%. Some very good reasons for that, but before you take that into account, two of those companies are misclassified by the MSCI people. Both Monsanto and Syngenta, which are now modified seed companies, are really biotech companies. They should really no longer be classified as fertilizer companies or chemical companies. Having said that, we have increased the exposure for very good reasons. Last year, in September, agribusiness stocks were sold down to very low levels. One of the companies in our top 10, CF Industries, a US fertilizer company, was sold to a PE under 6 times next year's earnings or the current year's earnings. It did recover somewhat going into January, February, March, but again in May of this year, there was another sell down. Now these sell downs have occurred in the agribusiness sector because there's a belief there's a correlation between GDP growth and food prices. There's no correlation between GDP growth and food prices because people have to continue to eat during an economic downturn. Indeed, food consumption has continued to rise since the GFC started over 5 years ago. And it's going to continue to rise because we've got 100 million new mouths to feed each year. So that provided a mispricing opportunity. Again in May, CF Industries fell down to levels that we saw back in September, and indeed levels lower than we probably got to in 2008 in the middle of the crisis. But as people were seeing that we were going into an economic downturn again this year because of events in Europe, they sold their agribusiness stocks, and CF Industries and other fertilizer companies became relatively very, very cheap. So we've increased exposure to those, and at the moment it's probably higher than we've had at any time during the fund. That's also supported by our view of what's happening with commodity prices. Farm incomes remain high, farm balance sheets are the strongest they've been in decades. So farmers have money to spend on fertilizer, and these stocks are incredibly cheap at the moment. That's why we like them.
The last time we spoke, the fund was positive on the global organic food industry as well as the rise in popularity of generic food labels. Do you still hold the same views now, and has the fund added on to these positions?
We still like the outlook very much for organic food, and we do see that generic or private label, white label goods continue supermarket penetration globally. We've added an extra company, a German company that specializes in generic lines, and we have maintained our investment in the large supermarket chains. However, we've actually reduced that exposure marginally because the fertilizer stocks, as I mentioned, were so cheap. We've basically taken money from most of the other sectors to increase our exposure to fertilizers. That's the main reason for that.
How did the fund's portfolio respond with respect to the takeover interest in Viterra, which has been on the fund's top 5 holding list for some time?
Well, it was wonderful. The stock jumped 48% in the month. There was a takeover offer from the UK commodities house Glencore, and we decided to sell into that. We had for some time emphasised in our reporting that the supply chain managers, and Viterra was one, Viterra is the world's largest shipper of wheat, for instance, and it was selling on our figures at about a 70% discount to its net tangible assets. And it's good to see that that was recognised by Glencore when they offered a price 48% higher than the current market price. Within the supply chain managers, we still have 2 stocks in the top 10, Archer Daniels Midland and Bunge, and we believe they're trading at about a 20% discount to their NTAs as well. So I'm not suggesting they're about to be taken over, but some of these stocks are relatively very cheap.
Can you elaborate further on some investment ideas the fund is positive on and others where the fund is less keen to pursue?
As I said, we're happy with our positions in fertilizers. We still have some retail exposure. We do like the supply chain managers. I think an area that's going to remain of importance is biotechnology and modified seeds. We remain very confident of that. One of the things that we are concerned about is what's going on with world weather. We monitor this very closely. You'd be well aware that there's been drought in the United States. We've had the recent forest fires, for instance, in Colorado because of record high temperatures. We've been monitoring this over much of this year, and fortunately we've been able to position the portfolio to take advantage of that. We've been concerned that the US Department of Agriculture, with its crop reports for corn, where they said there'd be record plantings of corn, was misunderstood by the market. There were indeed record plantings of corn, but at the same time, the USDA was forecasting that inventories of corn wouldn't rise, and they were expecting a good crop. These drought conditions mean that we'll actually probably see less corn being harvested than is currently forecast. And as a consequence of that, we expect to see these inventories decline and corn prices are likely to hold up. That's also affecting soybean production from the United States, and there's also quite severe drought in Brazil and now developing as well again in Argentina. All of these things will affect soy production, and soy prices have responded. We're also witnessing drought in and around the Black Sea, across to Turkey and in parts of northern India now. The monsoon, for instance, hasn't been as good as had been predicted. So that's going to affect wheat production. So the three main cereal crops, corn, wheat and soybeans, I'm excluding rice. Rice seems to be okay, although there are signs of drought developing in China currently. Up the east coast of China, things look fairly grim. So basically, all the grains look to be fairly strong this year, and our portfolio, we believe, is positioned to do well from that.